Hello students, through this video clip I will practice how to create income statement by absorption approach and income statement by the contribution approach by identifying the relevant and irrelevant information to make the important business decision. So the example is here, the Codel company makes and sells 1 million seat covers at $40 million to Boeing. Total manufacturing cost is $30 million or $30 per unit. So $30 per unit times 1 million seat covers. So $30 million. Direct material costs are $14 million and direct labor costs are $6 million. So the company scheduled the predicted indirect manufacturing cost for the year ended December 31st, 2001. So let's just scan the information from the Schedule 1, indirect manufacturing variable cost, and indirect manufacturing fixed cost. And Schedule 3, the selling expense and administrative expense. As we discussed in class, we can make income statement by absorption approach, segmented by manufacturing cost of goods sold, including all the manufacturing cost, and include the selling and administrative expense of fixed or variable cost. Anyway, that is the approach, absorption approach by financial accounting. We also have the different approach by the contribution approach. Now we segment this all the cost by the variable cost and the fixed cost, so that we come up with contribution margin to make relevant information, relevant decision making, and we will identify which information is relevant or not. Okay. So to construct the decision model, income statement by approach, the absorption approach. And can Codel sell the additional order? Oh, the company got the additional order of 1 million seats at $28 million. $28 million sales price, selling, so sales amount should be covering all the manufacturing cost of goods sold, right? So that the company can take this special order, additional order. Okay, so let's take all this information into this income statement. We have $40 million, but in thousands, so 40,000. That means the 40 million in dimension of thousands. Now the manufacturing cost of goods sold. Now direct direct materials. How much is that? Yes, how much is that? We have direct material cost is 6 million. And other, oh, sorry, that is direct material of 14,000. And direct labor cost is 6,000, which is 6 million. And then indirect production cost, indirect manufacturing cost. Where do you get it? Here you go. Indirect manufacturing variable cost. Now we got indirect manufacturing variable cost, which is the 4,000, and indirect manufacturing fixed cost, because we gather all together into the manufacturing cost. So 6,000, but I want to show it as a negative, so that you can recognize very easily it is at the expense. So I'm gonna change all this number in negative. So let's sum up this all the manufacturing cost. So let's sum up. So $30,000 gross margin is the sales plus minus the manufacturing cost. So 10,000 is the gross margin. Then let's collect the administrative periodic cost, selling and administrative expense from this schedule. So regardless of any types of variable or fixed, we collect all the selling and administrative expense. Here you go. The selling expense is, those are the fixed and the selling expense, fixed and variable. We include everything. So in order to identify if it is including everything, so okay, let me change it like that. Selling expense variable and fixed. So that is easy to convert, variable and fixed. So I got it. Also, the administrative expense variable and fixed, how much? 2,000 here. We collect 2,000. Now, let's sum up these two: selling and administrative expenses, all the variable and fixed. Then how much is operating income? Yes, 2,000. Now we have to determine that $28 million should be greater than definitely gross margin. The manufacturing cost of goods sold. But problem is this 28,000 of additional selling price, the 1 million seats is lower than this manufacturing cost. So if we create the income statement by absorption approach, we can make a decision that we cannot take this $28 million, the special order. But let's create the same situation, but let's create income statement by contribution margin approach. We have the same information, 40,000 sales. Then let's variable cost. Now we have to identify which one is only the variable cost. So we also have the direct material cost and the direct labor, which is the variable cost. So we have the same information up to here, but now we have to collect only the variable cost, only the variable, the indirect manufacturing variable cost, or the variable cost. Here, indirect manufacturing variable cost. In order to learn this procedure, I'm gonna collect from here in the schedule. So 4,000, which is variable cost. Where is the variable cost? Okay, here we go. The variable selling expense also. So the selling expense variable cost. Selling expense variable cost is now 2,000. We have to take only this 2,000 out of the total sales, right? So the selling expenses. Then administrative expense variable cost, only the variable cost. Here, variable cost minus 200. So the reason why we collect only variable cost is that the cost to behavior of the variable cost of the direct material, direct labor, indirect manufacturing variable cost, the selling expense variable cost, the administrative expense variable cost are the same. They are moving the same along with the cost of driver or number of units sold or number of units produced. They are moving in the same way along with the cost of behavior, right? Cost of driver. So let me sum up this total amount. So 26,200. You already noticed, recognize it. We make contribution margin, which is the sales minus the variable cost, 13,800, which is higher than the gross margin because the total variable cost is lower than the manufacturing cost of goods sold by this absorption approach. So the results are totally different. $28 million additional order of 1 million seats now definitely higher than this variable cost, so that the company make a decision that they takes this special order for $28 million additional sales. So the difference between two, definitely they can make a profit. Okay, because the fixed cost is irrelevant information. If they have the space, idle space, that anyway they have to take the order. If that order, special or additional order, is greater than the variable cost, they have to produce more and more and more to cover this fixed cost, right? So the fixed cost, which is irrelevant information, now I'm taking only fixed cost. Indirect manufacturing cost, $6 million. And then where is the fixed cost? Only the fixed cost, right? Here the selling expense, now fixed cost. Where is the fixed cost? Here we go. 4,000 advertising, sales, and salaries, minus 4,000 out of 60. And then finally, administrative fixed cost. Administrative fixed cost is minus 1,800, 1.8 million. Okay, and then let's sum up. Anyway, operating income from the absorption approach or from the contribution approach should be the same. Results are the same, because we are gathering all these expenses, costs, manufacturing, or the administrative and selling expenses, all the cost, regardless of what the types of cost is. So here, 2,000 are the same, but do you see, we make different decision based on this contribution margin approach, because the variable cost is lower than the additional the sales order of 1 million seat, $28 million higher than this total variable cost. We can still make more seat, so that we can make the profit to cover the fixed cost. Okay, if we did not take this order, we will lose the chance to cover this fixed cost, $8,000. Okay, so let's ask just one more time to identify which one should have been relevant in absorption model. Here, definitely the fixed cost is irrelevant, right? But here, do you see? The variable selling expense and the variable administrative expense should have been relevant in the absorption method, because it should be included in here, right? In here. So the should be relevant was selling expense. Oh, sorry. Should be selling expense variable, and administrative expense variable that was not included in this decision making from the sales, additional sales. So that was the 2,000 and 200. That was relevant information. So total 2,200. What should have been irrelevant? That in the absorption approach, the fixed cost was irrelevant, regardless of taking this special order or not. This fixed cost doesn't change. They have to spend this fixed cost anyway. So it should have been irrelevant in the absorption approach. So I'm going to take this out. So 6,000 was irrelevant information in absorption model. So the difference between two is 3,800, exactly the difference between the contribution margin or contribution margin, or the difference between manufacturing and the variable cost. Okay? In order to make operational decision or special whether to take the special order or not, we should collect all the cost information by classifying the variable cost and the fixed cost. That is much accurate information gathering. So it's very important exercise. Okay? So see you in the next video clip.